Thank you, sir. Thank you all for attending this afternoon. My name is Bill Bymel. I'm going to spend the next 15 to 20 minutes telling you a little bit about the secondary mortgage market, what we're seeing in the financial markets and the mortgage industry as a result of COVID and the market changes in the last 60 to 90 days. Talk about frontline witnesses that we've seen to deals that are happening today, what opportunity exists, and try to give you some glimpse into our expectations for the next 6 to 12 months. I encourage you to enter your questions in the chats below this presentation. I will try to get to as many questions live as possible inside this 20-minute presentation. And for those questions I am not able to attend to live, we'll copy and paste everything over to our group chat in the virtual exhibit hall. Just visit Spurs Capital and meet with one of our team. My name is Bill Bymel. I'm the managing director of Spurs Capital. I'm approaching 2 decades in the real estate and mortgage business. Native of South Florida, graduate of NYU, currently living in Southern California. I started in real estate as a fix and flip residential investor in the early 2000s. I got into mortgage loan origination like everyone in the middle 2000s. Moved into commercial real estate, representing national tenants and retail and restaurant clients in their expansion around the South Florida area. And then in 2008, as markets were in a very similar situation we're in today, I got a random phone call from a fund manager in Southern California. He had access to buy mortgages on the secondary mortgage market for pennies on the dollar. It's severe discounts to their face value. For me, this was a light bulb moment. This was an opportunity I didn't want to pass up, so I jumped into the non-performing loan space and have not looked back since. As a matter of fact, when we joined this business, my partners and I got together and created a new paradigm for buying NPLs and how to work those out with the borrower to create amazing returns for our investment partners and to also do good for our societies and communities and the borrowers that we serve. All of that is discussed in my book, Win Revolution, which is available on Amazon or barnesandnoble.com. I will be giving away free PDF copies of my book for those that visit us in the exhibit hall this afternoon. And I hope you enjoy that. Spurs Capital, I joined that firm in 2010. I am a signatory to 3 of our active funds currently. We have headquarters in New York City in the Fashion District, offices in Colorado, Florida, and California. We've placed close to $1 billion with a B in equity investments in the non-performing, sub-performing residential mortgage space since founding our first fund, our Goshen Fund, in 2010. We have no leverage on any of our funds. We are strictly equity. We have a lot of dry powder, and that's what allows us to get access to opportunities at severe discounts. We've gotten so good at what we do that larger mortgage investors, well-known names in this industry that you would all recognize, have actually hired us as third-party loss mitigation advisors in specific areas where we specialize, such as the New York tri-state area. Our key to our strategy is servicer surveillance, right? We use our connections on Wall Street to access loans at a discount, and then we watch our servicers, make sure they do their job, and then we take those Wall Street connections and apply a Main Street practice to resolving these troubled loans. We act as a lifeboat to individual borrowers, and that's how we arbitrage investment opportunity, good returns for our investors. So where are we today? Many of you might have been around 12 years ago when we had our last financial crisis. And at the time, debt loads were high. People thought, well, it's time to deleverage, right? Lower interest rates, let's deleverage, let's play it smart next time. Well, that decade of deleveraging didn't quite turn out the way we hoped. If you look at this report from Bloomberg in 2019, that graph right there shows you that the only sector actually that got smart about leverage was the financial sector. It's pretty much stayed stagnant the last decade. In the meantime, non-financial corporate debt has increased exponentially, household debt, obviously government debt. So we are borrowing more money now and have more total debt than we did a decade ago, the last time this crisis came along. In traditional markets, we always see some level of distress, right? The normal mortgage market has 2 to 4% default rates on average through the lifetime of the history of credit markets. When things really got bad in 2008, 2009, those default rates multiplied by 7 to 10 times. So we were seeing default rates around the country. We haven't yet seen that here in 2020, but we did get a little bit of a glimpse of the potential problems that lie ahead back in March as this COVID pandemic stepped in and businesses shut down. We heard Sean Morris talk about it a little into that last presentation, which was great. We heard panelists earlier this morning talking about some financial instabilities, and we saw articles like this in CNBC where credit markets were signaling U.S. Risks toward another financial crisis. See, the secondary mortgage market is a very important aspect of real estate, right? If we think of money as the gas that we use to buy real estate, the secondary mortgage market is the pipelines that delivers that gas to us as investors, to homeowners who are looking to buy a home, etc. So nobody notices the pipelines that deliver gas to our gas stations. But if the price of that gas were to double overnight, i.e. interest rates were to increase, we would all notice. If all of a sudden the gas at your gas pump stopped flowing at significant rates because there was some crack deep in the pipeline, then that can be a very, very bad thing for our markets. And we started to see that in March. We started to see mark-to-market margin calls, credit facilities shut down, liquidity was drying up. We were heading straight towards the cliff yet again. And luckily, I guess we could say that Congress and the Fed stepped in and came to secondary mortgage markets rescue. So the one big unknown in the looking ahead to the next 6 to 12 months is what actions will the Fed and will the US government take to prop up this market? For now, they are a liquidity provider of last resort. They came in with an open checkbook, started printing more money, giving it to providing that liquidity, becoming the liquidity of last resort for many of these institutional investors. And once again, of course, kicked the can down the road. Liquidity was a problem before COVID. I just want to point that out. Just going back to this last slide, you saw this article from Reuters up here, dollar funding and liquidity risk for 2020. And that article came in November before COVID was even on anyone's radar. So we were probably at the precipice of a market change anyways, remembering that markets are cyclical, but the pandemic obviously pushed that along. What happened during that March liquidity freeze for a few weeks was highly leveraged holders and investors of huge swaths of debt had margin calls. You had non-QM originators as well as some others as well that had their credit facilities either paused, and overnight originations ceased. We saw in the non-QM space, the non-qualified mortgage space, which is a very private market that doesn't necessarily have a lot of open data for us to draw from because of their private companies. But we saw a number of these private organizations, originators, wholesalers, lenders just disappear overnight. Many had to shut down for a period of time. Some have not come back, huge layoffs. And those that did come back have come back with completely different guidelines for lending new money, stricter guidelines. And the reason for this is, in my opinion, as it relates to non-QM debt, is the fact that there's already was some distress in that market. If you were an investor in a hard money debt fund, then you probably have experienced the fact that the default rates in hard money loans are much higher than the average. We've already seen default rates in non-QM pre-COVID that are above 10%. These are investor loans, fix and flip loans, buy to rent loans. Anybody that doesn't own or occupy their property. So what we saw was a situation where a couple of lenders, in order to restart operations, had to move the bad paper off their books. When things are good and there's plenty of money in the market, the credit facilities don't mind letting non-performing debt sit on the balance sheets. And because they know that it's working its way through a foreclosure or some kind of loss mitigation effort, and that eventually that will get paid off. But the problem with it is that when money dries up, those credit facilities, those banks have the ability to mark those loans down to market. They have that ability, and that's what they exercised in March. So many of these non-QM originators, we're seeing deals today that we never imagined seeing. We've backed up our bid 10, 12, 15 points from where we were buying in January, and we're still getting hit on trades. We're seeing guys that are having to sell at any number. And the reason for this is, if you're a highly leveraged investor or originator who has a credit facility, then the bank comes calling and says, look, we're not going to give you any new money until you move this bad paper off your books. That originator has two options. They could buy the entire loan themselves and 100% of it back from their credit facility and take care of the problem this way, or they can go to the secondary market and look for guys like us that are out there acting as liquidity providers, buyers of these assets, and take whatever number comes their way. And that's what many of them have chosen to do. Because if you're an originator and you have to take a 30% or a 40% loss on a loan, it's certainly better than having to pay your bank 100% and then not being able to use that money until it becomes liquid. See, the mark-to-market value of a non-performing loan, as Sean mentioned earlier, and as anyone in the financial markets will tell you, is when a loan's value to a bank is zero if it's not taking in payment, if it's non-performing. You and I know that there's underlying collateral. We buy first lien mortgages. We buy them at a discount to the face value of the underlying collateral. We know that there's value to be extracted from the homes that our loans encumber, and we feel it's a very safe investment, even as markets start to turn, level off, or maybe even decrease. So we just price changes in market conditions according to what we are seeing in the market today. So that underlying collateral value has some value, and we need to extract it. We take the value of the properties that we're looking at. We subtract what we think it'll cost us to carry that asset for 6, 12, 18 months until it's resolved. We back out additional expenses if we think that we're going to have to rehab properties and market them through brokers and servicing costs. And then we add in a little bit of a return. What it ends up with is we're buying loans at 50 or 60 cents on the dollar compared to their face value or compared to the value of the underlying collateral. And we arbitrage significant returns for our investors. We do this by working with our borrowers directly, by meeting them face to face. In many cases, our boots on the ground in all 50 states will go out and knock on doors and say to a borrower, we're not here to collect a debt, we're here to work something out. And really change the conversation to one of what can we do to help you? Now, the important thing to remember is this. There's a lot of uncertainty in the markets today. Is this the end of the world? Of course not. Markets are cyclical. My father used to say that anyone can make money in an up real estate market. What separates the men from the boys are those who recognize opportunity and create that for themselves when others are standing on the sideline. And that's really what we're here. We're here in this time and day and time today at a time when many people there's a lot of uncertainty in the market. And what that's done is created tremendous opportunity. We're seeing it both on the leveraged CMBS side, we're seeing it on the non-QM side, and depending upon when the Fed stops propping up the secondary mortgage market or when the stock market comes to some level of reality and things, the situations that have occurred here come to fruition and people really wake up to what's going on. But the opportunity is now. We see the big wild card being the Fed. Will it be 6 months? Will it be 12? Will they wait until after the election? My guess is they'll continue to try to pump money into our markets to prop up the secondary markets, but there's already a tremendous amount of stress as it exists today. And so as you're looking at this market, either as an investor, an operator, or just somebody that's interested in the secondary mortgage market, I hope you'll have a chance to read my book, learn a little bit more about what we do. If you're invested in the debt space now, maybe you want to check in and make sure that your investments are not leveraged, because being in a leveraged position at times of market liquidity issues can become very, very, very bad for your investments. Keep an eye on your delinquency reports. I just want to mention that in September of 2020 is probably later this year, September, October is when we're really starting to see what's going on. Remember, we had a 90-day foreclosure moratorium, 90-day, which is now continuing and going even further. But the 90-day payment stalls has ended. And so it won't be another 60 to 90 days until we really get a sense of how much is in default, because a loan is not really considered an NPL until a borrower has missed 3 payments. Let me answer one question from Jason Bradley before we finish here. What's the best way to purchase NPL? Do you reach out to the banks? Very good question, Jason. In the beginning of this cycle, of the last cycle, we were doing a lot of business with banks. We would reach out to the credit managers at local community banks. There aren't as many these days as there were 10 years ago. We were talking to the capital markets division at larger institutions. But that's a very, very difficult road, right? It's like cold calling anyone. It's not easy. A lot of the secondary mortgage market relationships are built on trust and years of working with people. My partners have been trading loans since I was probably in high school, a lot of them. And so a lot of the guys that they grew up with at Credit Suisse, First Boston, DLJ, UBS, Merrill Lynch, these guys that sit on these loan trading desks have spanned out to private equity firms. So we do a lot of our purchasing from larger institutional firms, investors in the space that are either looking for a small amount of liquidity or in some kind of a forced sale. And that's just a networking thing. I expect that as the market becomes more in distress, we'll see more opportunity for a new investor to make connections and buy that paper. But for now, your best way to buy NPL is to do so through someone like our firm that has the connections to get you it. With that in mind, I believe we are done. And I want to thank you all for attending. I'd love to take more questions. We will meet you in the in the virtual exhibit hall. Visit us at Spurs Capital. If you have any other questions, feel free to send us an email. You've got my contact information right there. Until then, be safe, be good, and I look forward to meeting you all soon. Bye-bye.